Okay, so we've moved away from our usual or our recent topics which have been based around ACCA, and we're now back to our IPSAS implementations. And this is a topic where we were approached to prepare some documentation for a government in Asia. So just let me get my coffee. Where we were asked to, we were told that we'd won a tender, and so could we get ready to do this? And then at the last minute, the government pulled out, and there were some complications with the contract. So I figured that rather than just waste the material, we would actually use the material. So here we go. This is all about reporting entity. Right, what does this actually mean? Reporting entity is looking at two things. Number one is who has to prepare sets of accounts. So remember, this is IPSAS implementation. Who has to actually prepare sets of accounts? And the second thing it's looking at is who has to prepare sets of consolidated accounts. Now, we've just had a whole new load of new standards out, so IPSAS number 35. That's good. IPSAS number 35 talks about consolidation, and a part of IPSAS number 35, therefore, is who actually has to prepare sets of accounts. Now, the reality of this is that, reality in real life, is that once IPSAS is adopted, there's a huge scramble that goes on. The huge scramble that goes on is that organisations don't actually want to produce IPSAS accounts because it means training all of their staff, changing their accounting systems, getting a whole load of new reports which people, one, don't understand, and two, can't be bothered to take the time and trouble to understand. So it becomes a huge discussion in real life, and usually what happens is that most people end up actually doing nothing. And the government on a national scale will produce accounts. As time goes by and we get some smarter people who are a bit more motivated, who actually want to make some better decisions, or want to track money more carefully, and we'll come back to our fraud and corruption slides as well another day, then that will change. But to begin with, usually most organisations don't do this. In terms of what we were supposed to be doing, we were supposed to be simply therefore for the sake of completeness, completing implementation instructions on a reporting entity. That sadly didn't happen, so we missed out on a half-decent fee there. Right, let's move on then. As I said, I don't think this is going to be a lot of laughs because it's a lot of based around definitions, but let's give it a go and do our best there. Okay, there's a lot of slides, so I think we've got 18 slides, which is a lot, because normally I just stand and talk. But the reason that these slides are so sort of formal is because what happened was I actually prepared a draft document. We actually prepared something for approval by the ministry. That document sadly didn't get used, and even more sadly didn't get paid for. So therefore, you can read the slide yourself. The course provides guidance on which entities, so which organisations should actually prepare sets of accounts, and then also, which is more of a discussion, who should prepare consolidated accounts. As I said, ultimately, very, very few governments provide consolidated accounts at all. They just take the national cash flow statements and then put some accruals and prepayments and assets and things in them. But this is the official line, and it ties in nicely with IPSAS number 35. So it ties in with IPSAS number 35. Okay, there's really not much more to say on that. Okay, the different types of organisations. So this is what we're looking at here now. So the title of the slide says who prepares accounts 1. So there are actually 5 different types of government bodies that we look at, or 5 different types of bodies that are controlled by government that we look at. And these are organisations that should prepare accounts, under IPSAS. Bearing in mind that we don't include commercial organisations, so normally we wouldn't include the central bank, and anything else which is run to make a profit shouldn't be included under IPSAS. It should be included under IFRS. Now that can give you consolidation issues at the end of the year, but that's another lecture. So let's just look at the 5 different types of bodies that we have that are preparing accounts. So on this slide we've got 2, then there's who prepares accounts 2, who prepares accounts 3. But look at the other 3. So 5 different types of government bodies. Right, the first one is the core government. Now this is the kind of government that everybody understands what it is. So this is your whatever happens in your parliament, for example. And usually your basic ministries as well, so Ministry of Transport, Ministry of Education, Ministry of Health, and so on. These are the kinds of things that nobody ever kind of really makes a mistake. sake about. Okay, so I hope that you're clear on what is your core government. If you want to have a good look at something that's interesting to read on this as well, have a look at the Australian government accounts. You can Google them, and if you Google up the Australian government accounts, you'll see that they split government into what they call core government and then extra government as well. So preparing basically two sets of accounts. Right, so here we go. Then we have the agencies. So the agencies are agencies that carry out the functions of government. So basically, if you look at it in terms like the United Nations is a good theoretical example. You have the Secretariat of the United Nations, which makes policy, and then you have the agencies of the United Nations, which carries out those policies. So you have the United Nations will say, okay, well, it's a fundamental basic right that children have to be looked after, and then the agency that actually deals with the implementation of policies related to children is UNICEF. Yeah. Similarly, we then have UNDP, United Nations Development Programme, and the UNDP is the administrative function. So we get this idea of the core, and then we get this idea of agencies, so we're actually carrying out the policies. So on slide 1, we saw that we had organisations that were pure government, so this idea of the Parliament, and then we had the agencies which are carrying out the policies of the central government. Now, as I said, there are 5 different types, so you've seen 2 already. As we go through these, we're moving away from central government to more and more kind of private enterprises. So what we've got up here, it says he prepares accounts number 2 is the name of the slide. And then we've got public enterprises. Right, public enterprises are government organisations, but often what's happening is that they get some money from private government and they get some money from private government, some money from the government, and some money externally. Where you're starting to see this, particularly now in places like Great Britain, is universities. So universities get certain sums of money which are centrally funded, government funded, particularly things like research are government funded. Then they'll do private research. They get certain sums of money from the government to subsidise British students going to university, and certain sums of money come from private enterprise. So we get this idea of a split. You've got some government money, some private money. Other things in terms of Britain as well would be the Statistics Office. So the Statistics Office gathers all statistics about business and blah, 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 that it gets from the Inland Revenue, the tax authorities. It gathers this stuff, and its underlying purpose is that it's used by the government. So it's funded by the government. But in addition to that, they will sell this information. So they publish books on whatever nature reserves, or they publish books on levels of unemployment and so on. And the point is that if you want to set up a business, you can see where there are skills for unemployed people or whatever. And the HMSO bookshops, therefore, will sell these government books. So again, we get this idea that we're preparing information for government, but that information has a market value. And so within that market value, we can sell it. So we get the split between the government funding, private funding. Certain types of school, when I worked in Kazakhstan, kindergartens in Kazakhstan as well, a certain number of places have to be provided free, and they're funded by the government, and then they can charge fees for a certain number of places. So, started off with government, then we got 100% funded government agencies. Now we're moving on to public enterprises, which are split, and you can see where this is going. So, following our train of thought, we get businesses which here we call state businesses. As general economic theory goes, general economic theory tells us that government should not interfere in markets, should not compete with private enterprise, but they do. If you're looking at Western European, Britain, for example, then there are lending agencies. Those lending agencies work as banks, and the underlying principle is that what they are supposed to do is they are supposed to lend to organisations which normal commercial banks would not lend to, because the risk is much, much higher. The reality of those lending agencies is they just work exactly like banks, but they do give out some sort of grants and stuff. So state businesses are government-owned businesses, but those businesses are commercial in their nature. Again, when I worked in Kazakhstan, the Ministry of Finance had its own training center, and the principle was it was to provide training to the Ministry of Finance. The reality was that they provided ACCA training at fees, and they were the best provider in the market in Astana. So state businesses is number 4. Remember, we've got 5 of these things. So we've got the government, we've got the agencies, then we've got those in-betweens that get 50-50 or some proportion. Now we've got state businesses that are commercial. Right, please notice that if they are commercial, they should be preparing accounts under IFRS, not under IPSAS. And then finally, we've got public contractors. Right, these are companies which are owned independently, but which basically provide all of their services to the government. You see these where you get special purpose ventures set up. The American government, for example, for the military, they have this incredible budget that they spend on the military. So a couple of guys who are contractors will set up a business and they will provide consulting services to the American military. Under the terms of the contract, they will only be allowed to work for the American military, because there can never be any conflict of interest, never any sharing of skills and information. So, therefore, we would often limit those things. We would often call those things, according to the slides here, we're calling them not for profit. They are for profit, and that the guys take all the money out in their salaries. But we get this idea of organisations that just work for the government. We would also get sort of pseudo charities where you would get people to set up funds to help refugees or victims of a famine or a drought or something, and they would get money from the government itself as well. Right, we've got these 5 different types of organisations. Those are the types of organisations, therefore, that should be preparing sets of accounts. Remember, if your organisation is commercial, we have it under IFRS. If it's government, state funded, and it's not commercial, then it should be under IPSAS. Therefore, in terms of general guidelines, remember what our question is: which entity, which business sector, or what part of the business actually needs to prepare a set of accounts? So the conceptual framework, which hasn't been adopted as of the date of this, because now it's March 2015, but we're expecting to be adopted, gives us 4 basic guidelines. And it says, look at your indicators here. Can your business unit, your business sector, your organisation raise or deploy public money? So does it get given funds as a separate entity itself? And in fact, usually in real life, when you do this, you look at what are the budget entities. Remember with IPSAS that we're always tying into the treasury function to the budget function as well. If you are considered to be a budget unit that gets allocated a budget, then it's almost certain that you'll have to prepare a set of accounts. So can it raise or deploy public monies? Is it allowed to acquire assets in its own right? Can it incur liabilities? And does it undertake activities to achieve service delivery objectives? Once again, as I said, what we did in Kazakhstan and Kyrgyzstan and what you do in most countries is just look at the budget. If it's a budget unit, it prepares a set of accounts. But those are the guidelines there if you're not sure, or if you're setting up a new business, so the thing doesn't exist already. But make sure if you're doing this in real life that you look at what your budget requirements are. And as I said, this is from the conceptual framework, so you can go on to IFAC's website and you can look at this. The first parts don't come from there. So just to give a little bit more guidance, if that wasn't quite clear enough, remember who prepares a set of accounts. So entities are things that will have to prepare a set of individual IPSAS statements. Public entities, so a public entity are those entities which are set up in some legal system in their own right. So the Ministry of Finance will be formed by Her Majesty if it's in Britain. If you're in a republic, it's constitutionally written up that the thing will exist. And there will be a list of entities that have to exist. Education will be one, for example. Municipalities, Parliament and the trading legislatures, and trading entities. All of these things will have something which, if it's a private company, we would call it, a shareholders' charter. So on the grounds that it's government, all of them will have some sort of document that says that legally they exist. So if you get hit by a lorry, for example, in the city of Birmingham in England, you can sue the city of Birmingham because the city of Birmingham exists as a government municipality. Right, so those are outlines of the kind of things you're looking for, but they have a legal substance to them. Please do remember that trading entities will be IFRS and not IPSAS. But what we're looking at the moment is who has to prepare a set of accounts. Okay? Okay, so this is just a very, very short slide, but it's just to make completely clear the position. As I told you at the start, we wrote this for a government. So these are just lines that we've put in the standard because it's to ensure that all municipalities, ministries, and everybody who are actually using the IPSAS, and the IPSAS now matches IFRS anyway, that it's applicable to everybody. So no one can try and shuffle out from under this. So applicable to all entities. IPSAS 35 is consolidation. Yeah. Who all entities on the accrual basis of accounting. Right, that's important because remember that certain government entities won't move on to the accrual basis. The Treasury, for example, won't move on to the accrual basis, and it's probable that things like budget won't either. The budget department will prepare its own accounts under accrual, but the budget is prepared under a cash basis. So it's just setting up who it applies to and who it doesn't. And it says when the entity elects or is required, most countries don't have much of a concept of election, to present separate financial statements. The standard will also apply to controlled entities and associates and others as well. Now, in fact, the reality is that there's 34, 35, 36, 37. So these standards will all apply across the board there. So it's not just going to be one standard that applies there. But it also means that you can't just decide who's going to consolidate and then kind of stop there and account for joint ventures in a different way. IPSAS, the whole broad spread of IPSAS consolidation standards will apply to all entities who undertake this. Okay, so this is just to give you an overview of what you're actually doing here. So it's called it the big picture. And we've kind of moved on now from individual organisations now to talking about organisations who are going to have to prepare consolidated financial statements. So we call them here the consolidated financials. So then we come down to the three boxes below. So it says identification. Right, with identification, what the question is who has to prepare consolidated accounts under IPSAS? So that's what we're actually looking at now. Who actually has to prepare these things? So part number one, who has to prepare them? And that's what all of this topic and these lectures are about today. We're not going to go any further on than that. Within your actual consolidated financials, therefore, you've got this idea of the consolidation procedures. So we'll probably do some other topics, we'll put them under IFRS. The topics are the same, but how we actually prepare a set of consolidated financial statements, what goes in, what comes out, how you eliminate intercompany profits and how we intercompany investments and so on. And that's all of the procedures. And it's fairly straightforward, and as far as these things go, there's absolutely no shortage of material on that. So we'll probably put something up later about that. And then a couple of little special situations that I put on there. Loss of control. So what happens is if you have something which is consolidated, and then during the year it stops meeting the requirements of consolidation, so you have a park period. And then impairment losses. What happens if you have an investment in a subsidiary, and due to some particular reason, the value of that falls, and that's what we've got this idea of impairment loss. So that's consolidated, and then we have our individual financials. This is where we have an individual organisation, and what are the disclosure requirements? Because under the standards, even if you are consolidated, you'll get consolidated accounts for the group, but then if you have an individual organisation, it has to prepare its individual accounts as well. And what are the specific disclosure requirements that relate to this idea of related parties and so on and so forth. So that's where we are with those things. By far the most important for the purpose of this class is just the identification and who do we actually control. Because in real life that could be quite contentious. To have an organisation that admits that it's controlled by another organisation, not as straightforward as you might think. Okay, so it's that fairly boring part now where we have to go through a whole load of definitions. An economic entity here is the group which is going to produce a set of consolidated accounts. So we're going to take 3 or 4 different government agencies and we're going to add those accounts together. In terms of things like the United Nations, this is where they are moving. So UNDP, which is the admin block, together with UNICEF, UN Women, UN Ops, which is the construction company. Those organisations at some stage I think are going to be consolidated. They all have falling revenue. So an economic entity is just a group. The controlling entity is the entity that has control. So the Ministry of Education controls a university, for example, and we'll talk about what constitutes control in a second. And the controlled entity is just the one on the bottom of that line, or the bottom of that heap. And control is the power to govern the financial and operating policies of another entity. Right, if you are sitting at work looking at this, I recommend you turn me off now and just read that to make sure you're clear. The next handful of slides are all going to be on the same topics as well. Definitions, there's not a lot of laughs in there, but you've got to get it right if you're doing this at work. Yeah. And the IPSAS does not give you all of this stuff. Okay, so this needs to be written. If you are writing this, send me an email and I'll send you the slides and you can cut and paste. Right, now, this I think is the key part to getting this correct. Have a look there, it says power conditions, that's the heading of the slide, but just have a look at the very first part, because what you've got to do is, I think, if you are working in an implementation team, you're going to have to draw up a set of criteria. Now, it says here, power conditions. And control is presumed when at least one power condition and one benefit condition exists, unless there is clear evidence in another organisation. So remember that. One power condition and one benefit condition. Right, what are your power conditions? Your power conditions are that we can directly or indirectly through controlled entities, blah, 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 control the decision-making process. So that's what it's saying here. We can control the decision-making process through controlled entities, so it self-owns, assuming that they're ordinary shares, it owns more than 50% of the shares. Otherwise, it can appoint and remove the majority of the board of directors, it can do something else which controls the voting, and there you go, cast the majority of the vote. So read the slide, it's fairly obvious if you're an accountant, but notice the thing at the start, because that's the key to this. One power condition and one benefit condition. So one power condition means we have the power to do something, and one benefit condition means that we can get the benefit from this organisation. And just to be clear in your head what it is you're talking about, we're talking about now organisations which are going to prepare consolidated sets of accounts. So you have one organisation up here. Does it control the second organisation down here? It does if it has one power and one benefit condition. Right, these are the power conditions. Okay, one power, one benefit. If it does, entity up here controls entity down here, and will prepare consolidated accounts for the two together, and maybe some others as well. Okay, so we talked on the last slide about power indicators, about the 50%, the ability to appoint directors to the board, etc., etc. So bearing in mind that that would be fairly clear for a private organisation, but for government it might be something slightly different. So here we've got this idea, first of all, it talks about the golden share. Right, this is very, very common, and governments often hold golden shares, things like water companies, electricity companies. Those companies in principle will be able to run themselves as they see fit, but the government will keep this idea of a golden share. And the golden share means that you can exercise your rights on that share to step in and take over the management of the organisation. Water companies, Britain, they still keep these things. And the reason is that they feel that private enterprise can run a water company better as long as people are getting water. But if they start to turn people's water off, or for example, if the Russians or the Chinese come in and want to buy a water company, then the government will step in and go, no. Right, that is still power, because you can control that organisation if you choose to. Okay, so we get this idea of a golden share. Other things that will give you an indication of power is the fact that you can change the organisation's mandate and change what it's supposed to do. You see this with certain organisations that are set up for medical things. You know, eradication of polio, then we eradicate polio, so do you close it down? Well, if you have an effective organisation that's raising funds, that's working well, then why don't you keep it going? Just give it something else to do. So if we can change the mission or the mandate of the organisation, then that will give us an indication of power. And if we can set borrowing, investment limits, and restrict revenue and so on, then those would be indications of power as well. All that we're doing here with these things here is, in slide number 1, we said, well, this is what you would expect to see if it was a commercial organisation. Right, we understand it's not, it's a government organisation, it's different. So these are other indicators that talk about power that you wouldn't expect to see in a standard commercial organisation. Right, if you remember, we talked about an indication that we should consolidate, that we have control over an organisation. Because remember, just to go back to what it is that we're talking about, what should be consolidated into each other? So what constitutes a group for the basis of IPSAS? So therefore, for the basis of IPSAS, we said if there's one power condition, one benefit condition. So now we're looking at the benefit conditions. So what benefit does the parent company, let's call it, get from the subsidiary? Right, has the power to dissolve the other entity, takes residual economic benefit. So in other words, if on a winding up, it gets all of the assets. And secondly, if it can take distribution. So if the company down here, the subsidiary company, if it pays dividends or some other distributions which are equivalent to dividends, if they go up to another company, then they are a sign that it is the parent that is the controlling entity. I think that's fairly straightforward. And there's nothing that you wouldn't expect to see there related to a normal commercial organisation. Okay, and this is just slide number 2, which talks about more benefit indicators. But between us, to be quite honest, I think this is very, very self-explanatory. The entity, so in other words, the parent company will receive a significant level of net assets of the subsidiary on liquidation. The entity can direct and cooperate. So in other words, it can use the subsidiary for the purposes of achieving its own goals. If the subsidiary company is liquidated, is the parent left with any liabilities? And finally, the parent company has access to the assets of the entity. And also you'll see there it has some sort of ongoing responsibility for the deficits, which is kind of more of the same related to the point above. I think it's all very, very straightforward. I hope that you all understand what those things are. You know, the Ministry of Education has some schools. It can direct to them what they have to teach. If a school closes, it will take over the assets and sell them off or put them to another use. If there's problems with a school and someone gets hurt, then the Ministry of Education will step in and meet any liabilities they may have. You can see what the benefits are individually there. I don't think that's very difficult. Okay, so these are just little exceptions. These are exceptions. There are basically two normal exceptions we would expect to see. The legislature, the Parliament. Right, if you think about it, the Parliament has the right to set laws. Therefore, in principle, it has control over everything, and therefore, in principle, everything should be combined into the Parliament. So usually we wouldn't, in fact, I've never seen this, that we would put everything into the Parliament. The government has the right to extend laws to everything, so therefore that means every single company in the world ought to be, in the country ought to be consolidated into the government. We don't take that. If they set a law, then they leave you to get on with it. Then we wouldn't normally combine in that situation. So the power of the legislature is normally ignored. Secondly, sources of finance as well. If you are a school, in principle, your money comes from the Ministry of Finance because they collect all the taxes, distribute all of the funds. We still wouldn't treat that as a consolidated action because the point is that they give you the money, but then as long as you're acting within the rules that exist, that they don't bother you anymore. And in fact, even if you're not, it will be the Ministry of Education that comes after you if you're a school. So therefore, the fact that we get this funding requirement, that does not constitute an obligation to consolidate. Okay. So usually, therefore, we wouldn't necessarily look at sources of funding, and we wouldn't necessarily look at sources of legislature. I hope that's fairly straightforward. But these things will come up in discussions, and you should be ready for that one. Right, these are just a couple of little examples just to try and help you out a little bit. I'm not sure how comprehensive they are, but a couple of little scenarios that we've seen in real life that have come up. So the first one is that an entity will only have the power to control another entity if the agreement is renegotiated to that effect. So you have a company here, or an organization here, and the point here is that currently the parent company does not control the subsidiary. Now, they will go into certain negotiations, and obviously negotiations will depend on who has the power and so on. But currently, they do not have the right to manage that subsidiary, that lower level entity. So therefore, currently, there is no requirement to produce consolidated accounts. Now, if as a function of or if as a result of the negotiations, it turns out that they can control who goes on the board of directors and so on, then obviously that situation will change. So you need to monitor that carefully. This sounds to me very much like something that comes from politics. Organisation A wants to control Organisation B, but currently they don't, but they hope that situation will change. That's what I'm hearing when I read that. Answer: the current position is that they do not control that organisation, so there is no requirement to produce consolidated accounts under IPSAS 35. Right, in scenario number 2 is kind of the opposite. It's political apathy. So organisation here can control organisation here, but it just never bothered for whatever reason. It's quite happy with what they're doing, it doesn't need the extra work, or no one's got the political will or whatever. Right, in that situation you do have to consolidate. The fact that they've never bothered to exercise their power doesn't make any difference. They have control, and that situation may change. You get a new controller in the future, or he sees that he likes what they're doing and he wants to channel it up, or they've got a lot of funds coming in and he wants to take control. Right, scenario number 2, you do have to consolidate. The fact that they have never ever used that power to control doesn't mean anything. They may in the future, and they can if they want to. And you may also find that when you highlight this up, that they start to as well, you'll find that IPSAS implementation will be the trigger for many things. So scenario number 1, no requirement to consolidate, because currently we don't have the power of management. And scenario number 2, there is a requirement. Just because you've never used it, the right exists. Okay, so here we have a nice little decision chart. Decision chart, that's what they're called, yeah. So, something that we always try to design. So, does our entity, our top, benefit from the activities of another entity? If the answer is yes, does the entity have the power to control? Yes. Is the power to govern financial and operating presently exercisable? That's what we saw before, yes. And it controls another entity. Right, if it controls another entity, then there's a requirement to prepare consolidated accounts. As you can see from the various shaped and formed arrows that go to no, no, and no, if it doesn't, then there's no control, so there's no requirement. But you should consider whether it's an associate or a joint venture within the other standards. Right, does it benefit? We've given you your benefit criteria, we gave you your power criteria, so hopefully you can judge from that. Okay, there you go. Right, I have to say that is not the most fascinating of topics ever. It will give you some very, very heated discussions when you do this within government as to who actually controls others. And many people will have opinions over whether they control an organisation or whether they are controlled by another organisation. Thanks for listening. If you've made it all the way to the end, I congratulate you on that. And if you have any questions, you know where we are. Send us a message to YouTube or to the website. Have fun.